Hello and welcome to this session. This is Professor Farhat. In this session, we're going to focus on the proprietary funds, and specifically, I'm going to focus only on the enterprise fund. So let's go ahead and get started. What are the proprietary fund? The proprietary funds are business type funds. So here we are dealing with business type funds. They are a little bit different than the other funds, which are the governmental fund. They're different than the general, special revenue, capital project, debt service, and the permanent fund. Those funds are run like business-like. Therefore, if they're business-like, then we're going to be using business-like accounting. And what's business-like accounting? We're going to be using the regular full accrual or accrual accounting. For the other funds, for the governmental, what we used modified accrual. Now, if you don't know what modified accrual is, go back and view the recording for the other funds. But this is the proprietary fund. We're going to be using accrual accounting. Here, the government is trying to make a profit. Examples will be, for example, the city of Philadelphia run the international airport. So therefore, airlines pay them a fee. People, when they travel, they pay a fee. It's a business-like environment. For example, the liquor store in Pennsylvania, they are run by the state. And for the proprietary funds, we have two funds. We have the enterprise fund and we have the internal service fund. When you hear about the enterprise fund, which is we're going to be discussing the enterprise fund, we are dealing with sales to outsiders, which is the general public. So the government fund, for example, the water utility or the Philadelphia International Airport Authority is administering the fund, and they are providing services to the general public, to the people. Okay, so it involved transaction with the general public. Now, on the other hand, the internal service fund, as the word suggests, internal service fund, it's sales to insiders, sales to other governmental department within that government. So you are not dealing with the outsiders, and we're going to look at this in the next session or so. Next session would look at the internal service funds. Okay, so transaction with parties internal to the government. Example could be the IT support, could be many other examples. For example, purchasing. All the government have only a central purchasing department or central printing department. This way they save money on these type of activities. Okay, again, internal service fund, we don't deal with it in this session. At some point soon, we're going to look at it. Those funds use accrual basis, so they account for all resources and obligations. The next question we might ask is, why do government get involved in enterprise or proprietary fund? Well, we could list few reasons. Let's go ahead and list some reasons. One is something called tax substitution or complementary activities. A good example will be if a city or a borough or a county run a museum. What's going to happen inside the museum? They might have a cafeteria, 3, 2, 1. Okay, the question is, why do government get involved in proprietary funds? Okay, many reasons. One reason could be what's called tax substitution or complementary activities. For example, if a city runs a museum, for example, Washington, D.C., the city of D.C., or the city of New York, what's going to happen is inside the museum, they might have a souvenir shop. So the souvenir shop is trying to make a profit. Now, why is the souvenir shop trying to make a profit? It's basically to finance the museum. So basically, rather than increasing the taxes on the people who are living in the city to finance the museum activities, what you can do, you can run a museum shop in there. And basically, it's called the form of tax substitution. Okay? Another example could be if the government is running the university, they may also run the cafeteria or the bookstore, basically complementary activities to what they do. Once again, to raise money for rather than raising the taxes. Another reason could be is control. For example, the government wants to be in control of a certain hospital. Okay, but why? Because it's an important to the community. It's a health. Therefore, they will run the hospital. It could be cheaper sometimes for the government to run certain things. For example, housing. Public housing or housing for low-income individuals. It's cheaper for the government to run the housing. Why it's cheaper? Because they pay no taxes. Therefore, they will be able to rent those housing at cheaper than a private landlord. Or it could be subsidies. So the government wants to provide certain services at a certain cost, and they can do so by subsidizing some of the services like a bus service or a golf course in the city. It could be any other reason, but those are some of the reasons. So just let's review. The proprietary fund uses accrual basis. And once we say accrual basis, it means we have the matching of revenues and expenses. And we also, since we have long-term assets, we also book depreciation. Remember, in the modified accrual, expenditure, the word expenditure drives everything. Not expenses, expenditure drives everything. Here, we have the matching of revenues and expenses, regular accrual. So the emphasis is on the income statement. Typically, we don't have a budget, we don't have encumbrances. Those are the accounts that we used in governmental accounting and modified accrual. Proprietary fund closing entries, all revenues, expenses, type of accounts, as well as transferred, are close to net position. Basically, net position, think of this as equity. It used to be called net asset, now it's called net position. No big deal. It's called net position. Think of it as equity, are close to equity. Now, let's take a look at an income statement, because it's important to see what the income statement would look like. Now, I don't do any specific accounting for the enterprise fund. Why? Because the assumption is you know how to do accrual accounting. But I'm going to look at a few things that are unique, a little bit unique to governmental accounting. So let's take a look at this income statement and see what it looks like, and see if we can, observe certain things. Well, notice the first thing, we start with revenues, which is very similar to private accounting, which is accrual accounting. So notice operating revenues. Now we have 12,000 of operating revenues minus operating expenses, not expenditure, operating expenses. Operating expenses, we get to total operating revenues minus total operating expenses equal to operating income, 2,500. This is actually operating income, just like we have operating income in what? In regular accounting or business accounting. Okay, we have operating income from a business. Okay, so this is called the statement of revenues and expenses and changes in net asset, and we're going to see why in a moment. Then from operating income, we might have non-operating revenues and expenses, and we should be familiar with those terms. Non-operating, it means they have nothing to do with their operation, such as state operating grant or some others. Then we have total non-operating revenues and expenses. It's revenues. So if we take operating revenues plus non-operating revenues and expenses, that's going to give us income before other revenues, other expenses, other gains, losses, and transfer. Then we have capital contribution. Now this is interesting. Capital contribution. Capital contribution is something new. So this is basically, in a sense, new or unique. Okay? Why? What is capital contribution? Capital contribution, what does capital contribution mean? If you think of capital contribution is when someone gives you money. Okay, when someone gives you money. In a private business, the way it works is this. When someone, and who gives money to private businesses? Actually stockholders. When the stockholders gives money, when the stockholder contribute money to the company, what they do, the company will debit cash, 5 million, and they will credit common stock, let's assume no par value stock, 5 million. So this is what happened in the real world. And not in the real world, in the private world. Those are balance sheet accounts. So this activities goes on the balance sheet. Simply put, it goes on the balance sheet. Okay? Now, when we have capital contribution, where could we have capital contribution? Simply put, who gives money to the government? Who's going to contribute money to the government? It could be another government. It could be another, like, for example, the federal government is given money to subsidize an activity. That could be a capital contribution. Why not? That could be a capital contribution. Or it could be a state government giving the city some funding, that could be another capital contribution. Anyone who's given money, okay? For example, if someone lend you money, so one government lend money to another government. They lend them the money. Now, this enterprise fund is not making a profit. So what happened? This government, they will forgive them. They'll say, okay, your debt is forgiven. So those basically are called capital contribution. Now, those are typical capital contributions. So we have external subsidies, internal subsidies, external to the government, internal within the government, or debt forgiveness. Now we also have what we called a certain contribution. They have to be split. So basically, certain capital contribution, they will have to be split between operating revenues and capital contribution. What are those? For example, tap fees. What are tap fees? This is a good example. For example, let's assume you move to a new city, and the city charges you a fee to hook you up to the water utility. So they charge you a fee. Let's assume the fee is $500. So they charge you a fee, and the fee is $500 to hook you up, okay, to the water system. Now, the amount of the fee, $500, may exceed the cost. For example, the cost to hook you up, the actual cost, so I'm going to break this into cost and excess of cost. So the actual cost, let's assume the actual cost is $200. Okay, so anything that has to do with the actual cost, which is $200 in this situation, what we do, we call this non-voluntary fee. So the actual cost is non-voluntary fee. Non-voluntary fee. And this amount, this $200, it goes under operating revenues. Now what's left is $300, which is in excess of the cost. We can call this voluntary fee. Now, you're not really voluntarily paying it, but as far as the government is concerned, this is a voluntary fee. The $300, the voluntary fee, will go under capital contribution. So this is something a little bit unique to enterprise fund. They have a line called capital contribution. Okay. Once again, in the business world, any capital contribution, as we know, capital contribution goes on the equity section of the balance sheet. It goes to common stock. Okay. So that's something that's a little bit unique. Also, what's unique, after we have arrived to net increase or decrease in net position, which is either net income or net loss, okay, which is here, it happens to be net income of $6,500. What we do is we have a rollover equity. So basically what's going to happen is we don't stop. So notice here, after we get to the bottom line, what we do is we add the beginning net position, then we get to the ending net position. So basically this is a rollover equity. Simply put, or you can think of it as the retained earnings statement, So notice you are giving two financial statements. So this is basically net income, and this is retained earnings statement. Basically retained earning is beginning retained earning plus net income equal ending retained earnings. So beginning, which is in here, was 20,000. Beginning was 20,000 plus the increase. The increase was 6,500. This is the increase, equal to the ending, which is 26,500 right here. So notice it's one statement, but it's basically in two, 1 and 2. So this is basically net income, or the not net income. We don't call it net income. We call it, remember, statement of revenues, expenses, and I emphasize the word expenses, and changes in net position. So two statement in one. Proprietary funds use economic resource measurement focus. It means we account for all assets and all liabilities. We report related capital asset acquisition and debt service activities within the proprietary fund. Of course, if we're accounting for all the assets and all the liabilities, any capital project fund and any debt is recorded in the enterprise fund. Okay? Construction of an enterprise capital asset are reported in the proprietary fund, not in the capital project fund. Payment for interest and principal are made from the proprietary fund, not the debt service fund. So think of the enterprise fund as a standalone company, standalone enterprise. Okay? So we account for all assets and all liabilities, and we'll look at the balance sheet in a moment. Okay? So we don't call it balance sheet specifically, we call it statement of net position. It includes both current and long-term assets and liabilities. All comprehensive, the economic resource measurement focus. It includes everything. Okay? So the statement of net position, it's not called the statement of net asset. And the reason I say it's not the statement of net asset, because on the next slide, you're going to see an example. It says net asset. And the reason is because it's an old example. They used to use the word net asset. Now they use net position. Regardless, think of statement of net position of net asset are the same, but we're going to call it net position, especially if you're going for your CPA exam, because that's the term that they use, statement of net position. Now, what is the statements of net position? Assets minus liabilities equal to net position. That's what really what it looks like. Okay. Now, Net position is reported under three categories. We're going to have three types of net position. We're going to have net position in capital asset, restricted net position, and unrestricted net position. So net position, it's going to be broken down into three components. Let's take a look at a statement of net position to illustrate what we need to do. And the reason I use this example, I believe I always used it. It's very helpful because it's going to show you what we need to see. Notice we have assets, cash and receivable. Non-current assets, notice we have non-current assets because it's the all economic focus. We're looking at everything. We have building, then we have accumulated depreciation, we have the total non-current, then we have current liabilities, long-term liabilities, and notice we have net asset. We have three groups. We have invested in capital asset, this is group 1, restricted for construction 2, and unrestricted 3. We have three net asset. Now I'm going to explain each one of them separately. Starting with invested in capital asset. How do we come up with this invested in capital asset? Well, invested in capital asset, we're going to take capital asset, go back here, we're going to take capital asset minus accumulated depreciation. And hopefully you remember this. This is the book value of the asset. We're going to take the book value of the asset minus any related outstanding debt, outstanding balance of debt incurred to acquire those capital assets. So any debt related to those assets are subtracted from it. So let's take a look at this example. In this example, we have capital asset. We have a building, 2 million, construction in progress, 1 million, minus accumulated depreciation of 200,000. So the book value of the capital asset is 2.8 million. So the book value is 2.8 million. Now what we're going to do, this is the book value. Then from the book value, we're going to subtract any debt related to the capital asset. And we're going to assume this revenue bond payable is related to the capital asset. We're going to make this assumption. So 2.8 million, which is the book value, minus 2 million. It's going to give us 800,000. And this is the net position, okay? Net position restricted. Restricted to what? That's the invested in capital asset, net of related debt. So this is where this 800,000, the first part of equity, came from. So it's the book value of the capital asset minus the related debt. And here we are saying the 2 million is incurred to buy those assets. We're making this assumption. Otherwise, you're going to be told. But the formula is this. Again, the formula is, let me do it again, capital asset minus accumulated depreciation minus debt. But remember, asset minus accumulated depreciation, this gives us the book value of the asset. Okay? So that's that. This is the first type of net asset. So we completed this one. We could also have restricted net asset. What is restricted net asset? We could have net asset that's restricted. Now, how do we come up with this restricted net asset? Well, we have to make an assumption here. I'm going to tell you that within this 2,062,000, 2 million of this cash is restricted for construction. Restricted for construction. Okay? So this is the asset. It's restricted for construction. So any asset, so here what's going to happen, so how do we come up with the net asset? It's asset minus liability equal to, the net asset restricted for that purpose. Net asset restricted. Here, we're going to have 2 million restricted. Therefore, we have 2 million in cash restricted minus, notice here we have 1 million in liabilities, and those are contract payable. Okay, contract payable. It's for the construction minus 1 million in liabilities. What's going to happen, what we're left is 1 million restricted net asset. And this is how we come up with this 1 million restricted for construction. Okay, so it's the asset minus the related liability. So the asset is 2 million in cash minus the related liability of 1 million in liabilities gives us 1 million in asset. Now what's going to keep us, it's going to, whatever is left is unrestricted. And basically what's unrestricted? Well, what's unrestricted is 62,000 of the 2,062,000. So 62,000 in cash, that's unrestricted, plus the 214,000 in receivable. Those two together equal to 276, and this is the unrestricted asset. So that's the asset that's not restricted to capital investment, that's not restricted for any purpose, the unrestricted asset. So this is what the balance sheet would look like, okay, for an enterprise fund. So this is something unique. Net asset is something unique. obviously different than a business. In a business, you have common stock, paid-in capital, retained earning, treasury stock. We don't have this. What we have is net asset, and net asset is broken down into 3 categories. Now, the best way to illustrate this is to really work an example to show you how net asset comes into play, how net asset appears on the books, because you saw the end product. This is basically the end product. End product means what? It means you're seeing the balance sheet and you're seeing the net asset. But how does it really work? Let's look at some journal entries to illustrate how net asset comes to be restricted. Okay, let's assume the government issue a 10 million in revenue bonds that are restricted to the construction of plant equipment. Okay, so what we do is we debit cash restricted and we credit revenue bond payable. Okay, so if we're looking at the balance sheet, okay, this is a balance sheet. This is, we have assets, we have liabilities, and we have net position. Now we added 10 million in assets in cash. This is the asset. Then we added 10 million in liabilities. Okay, so asset minus liabilities equal to 0. 10 minus 10 equal to 0. Therefore, we don't have to do anything now. Okay? The restricted cash is offset by the liability. 10 million minus 10 million. There is no need to reclassify the portion of the unrestricted net position as restricted. So we don't do any changes in net position because 10 million minus 10 million equal to 0. Okay? Let's assume subsequently the government set aside an additional 2 million to pay interest on the debt. So what we did now is we added 2 million to pay off the debt. So we restricted 2 million. Therefore, we credit cash. We reduce the regular cash, 2 million. We credit cash. And we debit another restricted cash, 2 million. Now what happened is we took 2 million from regular cash. Okay, we took 2 million from regular cash. We had it in here, and we moved it up here. Now we made it restricted. So now what we did is we took 2 million of unrestricted cash within the asset and make it restricted. Now what happened? The restricted amount, we added 2 million here. Now we have 12 million here. And we still have, we did not add anything to restricted liabilities. We have 10. Now we have 2 million in assets minus liabilities equal to 2 million net asset. And that's restricted. Now we need to do what? Now we have 2 million. We have to restrict 2 million, an additional 2 million. Now we have to make this entry. We are going to credit net position restricted. We are going to increase the restricted net position, and we're going to decrease the 2 million in unrestricted net position. So basically what happened here, whatever number we have here, we're going to take 2 from the unrestricted and make it restricted. So this was unrestricted, and this 2 new million is restricted. So that's what we did. So this is what ended up happening. So initially we did not need a journal entry. Then once we reclassify the cash, this is a reclassification entry. Then we need to make another reclassification entry for net position to show that we have 2 million in restricted asset, an additional 2 million. So hopefully this is a good illustration of how it works. If you have any questions, any comments, by all means email me. But and the next topic I'm going to cover is landfill cost, because that's something unique to enterprise fund, and it's a big number for many cities and counties. So if you have any questions, any comments, by all means email me, and study hard for your exam.